Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show and happy March.
And you too, Jim.
Danielle, one of the questions I get all the time right now is why is the Canadian dollar around 78 cents American when oil prices, even in Alberta, have topped $100 US?
Because the amount of panic that's in the world right now, and being the worst two months, January and February, to start any new year since 2008, it's basically driving a flight to the U.S. dollar, which dominates the propensity for the CAD to go up with the price of oil. So there is a funding crisis right now in the world because the fiscal impulse has been negative for some time, rolling over from the pandemic emergency injections, but also central banks, as you know, have begun tightening cycle. And they've also been reducing the amount of assets they're recycling on their balance sheet. So that means that not just the velocity of money has been negative for a long time, but now the actual M2 supply is contracting. And the world is basically mostly indebted in U.S. dollars. So they need that to buy the bulk of the world's commodities. They also need it to pay a huge amount of foreign debt is denominated in U.S. dollars, something like 40%. And so as a result, when we get into these falling prices, falling demand, contracting money impulse, you see a shortage of greenbacks, which means flows have to seek out raising them, and they inflate the U.S. dollar more than the CAD in this environment. I think the other thing that's quite evident is that the world is not giving a huge vote of confidence here to the Canadian economy despite this huge spike in oil prices. The reason, I think, is that because before, commodities leapt in the last 3 months, the world was already rolling over into the downturn. We'd already seen for example, small cap stocks flounder and be negative over the last year. We've already seen peak inflation. We've already seen peak profit margin, peak growth. Like, all of those things were really at a high within the past several months. And so, at the same time, you've got this rising rate environment, as I mentioned, which means that all these highly indebted companies and households are feeling the strain now as rates rise, and you layer on top of that, the increase in the cost of living through food and energy, which are these critical inputs, of course. So all of a sudden, they're having a capital shortfall in terms of their cash flow as well. And in Canada, unfortunately, we're really set up for pain here because, as you well know, we've had this housing bubble that's gone really boffo in the last 10 years and 5 years in particular, and certainly since the pandemic. While we've had, average wages go up 3 or 4%, we've had an increase in housing of about 50% just in the last 2 years. So as a result, the other thing is we have a lot of rental properties in the country that were built post 2018 are no longer rent controlled, and we have this big influx of investor money that is really booming into the amount of supply coming on stream, the amount of condos being built, and so initially, the constraint there in terms of how much rent landlords can increase if they're not rent controlled, some of them are finding opportunity to increase rent significantly, 20-25%, as new tenants move in, and that's really escalating the costs on the household too. So we've got this just basic funding crunch globally, and the fact that we have the spike in oil is negative for the economic cycle, for consumption. We've never had a 50% spike in the price of oil historically that has not led to a recession. So as I said, we were already tipping towards this really significant slowdown because of the fiscal and monetary impulse contraction, because of peak demand and consumption on goods, as I've described before during the pandemic, for those very extraordinary circumstances, the government stymies and people stuck in their house and low rates. But at this point, everything is kind of contracting, going the other way. At the same time that central banks are trying to tighten, at the same time that the yield curve is nearly completely flat, at the same time that S&P earnings are going negative in terms of their trend, the dollar index is at the highest now since June of 2020. So that basket of currency, again, the dollar against a basket of global currencies like the euro predominantly, but also the major currencies, is at the highest it's been since June 2020. So I think that is primarily the reason that there's a great deal of strife and a sort of not a vote of great confidence in Canada's economy, because our domestic economy is so weakened by this housing bubble and the bananas amount of debt that everyone's taken on. And also the revelation that these high prices in oil typically are the cure for high prices in oil. If you look back every single time since the early 1900s that commodity prices have become this rapidly, and the extent to which they're overbought today, it has always been a cycle high. Like, we're now just past the peak in 1993, 46, 1973. These are all classic cycle tops, and thereafter you saw a big decline in demand globally, because the economy slowed, because consumers figured out ways to cut costs and redirect. So all of that suggests that the spike in energy, and I don't use the euphemism energy prices, this is another distinction I think is important. They like to talk about energy prices in Canada, but actually it's oil and gas prices. We don't have a very diversified energy portfolio or sector, which has been a major underinvestment mistake over the past decade. So now the opportunity is to try and figure out how Canada is going to thrive and prosper over the next decade, how we're going to pay back all the money that's been borrowed while we have a secular downturn in commodities again. And I think that that's likely to be our greatest challenge in this environment. So I think that, the other thing is, I've talked about the real estate cycle before. Our February letter was focused entirely on that topic, and the statistics there are just really mind-blowing. At the same time that we have, as I said, the most unaffordable housing in the world, a mind-boggling ratio of household income of 6 to 12 times household income, when historically 3 times has been the most sustainable or affordable level. We still have this, influx of money, and this is part of the irony of the trucker protest and the government stopping the flow of funds to the protesters, when the elephant in the room is these incredible amounts of illicit inflows that have gone in: money laundering, oligarch money. The world is looking at Russian oligarchs today. We've had that kind of money, plus a lot of Chinese triad money. This is all Sam Cooper's work, of course, the investigative reporter who wrote Willful Blindness. So all this money has really flooded in, inflated our domestic real estate prices, caused huge distortions and frailty. At the same time, the investor class has been borrowing their brains out to try and bring on more supply, particularly in the major centers where the bulk of the population lives. And so now we have housing starts, building permits. These things are at 40 and 50-year highs today. So the amount of supply that's coming on stream here, again, high prices have incented more supply, just as the affordability aspect of these prices has, deteriorated significantly in recent months. And people always talk about, so the Bank of Canada raised rates this week by 0.25. Now we're at 0.5. The U.S. Central Bank is expected to hike rates a quarter point on March the 16th. They're currently at 0, Jim. So we've never, again, talk about, superlatives. We've never had a downturn cycle where we've got this amount of negative momentum at the same time that the central banks are trying to get off 0. So this is really a freakish concoction of a confluence of factors. And it means that things like everyone talks about the volatility in the system as if volatility is, some science project study, but really what it means is you've got a bunch of whipsawing going on, and more importantly, not just in the stock market where the VIX has moved above 30 in the past couple of months, but in the actual bond market, which again I've described many times, much bigger and more important than the stock market globally. The MOVE index there for treasuries is now above 110 again. It wasn't there, it was there last in March of 2020. At the same time, you've got, things like the Hong Kong stock market just broke below its 2020 low. Of course, Russian stocks are tanking and getting kicked out of indices. So this is very reminiscent of a bunch of trends that I recall vividly from, the Asian crisis in 1998 was kickstarted by Russia's default on its debt. And all the highly levered participants, of course, start to need to raise U.S. dollars and cash, cover their short positions, all this sort of thing. And so you have a lot of negative pressure to the downside. So I think that's really the recipe we've set ourselves up for. We're in the midst of a bear market here. We're not through it yet. I think there's a lot more shakeout to come.
Is it a good idea to borrow money to invest?
Well, this is the populist discussion, and this is endemic of a cycle peak too, is when you have, I lament the fact that we've just had RSP season close in Canada, so a bunch of people have made their annual savings contribution into RSPs at peak valuations in asset prices. So, we know for sure that the bulk of that money just flows directly into the stock market typically. Again, households are already at the highest equity exposure that they've been in a decade or more. And you get this price indiscriminate flows just going in because people think that's investing. And of course, most of the so-called advisors and brokers they're doing this through have no reason to stop them from buying financial products, even if they're toxically priced. So they just put their money in the instant they're given it, and you're seeing some of that flow coming in. Retail flows have been strong for the past several months, just as the insiders at corporations haven't been buying at all. It's a marked fall off in that indicator, and you're just, the smart money, as I've described before, for lack of a better word, which is the institutional risk managing money, has been, reducing their exposure to this cycle, just as the retail investor has been ramping it up. And then you add to that the idea that people are actually advised often to do these crazy things like Smith maneuver, where you borrow, gouge out whatever equity you may have in your house to put it into things like stocks and stock mutual funds. And they think this is, genius because you can tax deduct the interest. The reality, of course, is that the asset prices tend to plunge because it only becomes super popular at the peak of a cycle when risk reward is awful, when, the probability of loss is massive, and that's when people lever themselves in. So this is like the worst of all worlds, because what happens is the prices plunge. They don't typically rebound for years. Everyone's thinking that quick V in March 20 was typical of a bear market. It is not at all. A bear market typically falls for a year and more and doesn't recover for years thereafter. That's the kind of environment that I think we're set up for here. And what happens, of course, is if the people who borrowed to buy those assets see them fall precipitously, the debt does not. The amount that they're still owing on their home is a dead weight, and at the same time that interest rates are rising. So it's really a terrible concoction. My daughter, I noted on my blog today because my daughter texted me this morning from the GO train she was going to work this morning in Toronto, and she overheard a conversation of two men talking about the one telling them about this genius idea of the Smith maneuver and how you'll be able to retire at 50 if you take on this kind of contraption, and it's what all the smart money does and all this. That's all wrong. That's just the absolute blind leading the blind. That's the sales culture, getting people who have no money or small amounts of money and getting them to borrow so that they become larger profit centers for the investment sales side. That's the reality of it. And I can't really stress that enough. And that's why I wrote about it, to try and warn people off it.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Listener of the show, Dave has a few questions for you. And the first one is, given the market bubble with grossly overvalued stock, should I just go 100% cash or low risk bonds? Is it reasonable or undervalued PE ratio in the markets that would indicate a long-term bottom is in?
I don't think a long-term bottom is in by any stretch of the imagination. It's not possible to give random advice at a top-line level about how much, should a person be entirely in this or entirely in that. But I do recommend that people look at their risk exposure right now. The only things that really go up in this environment tend to be things like government bonds, the U.S. dollar, bullion to some extent, although I'm a little concerned that the bulk of that run has already taken place. We've already seen a lot of gains there. Again, that's part of this whole, inflation trade, which is now, I think, on its way out again. So I do think that people need to look at their cash weights, because cash is an optionality fund, and too few people actually end up with any cash. Mostly it's treated like a hot potato that you've got to get rid of at all times. And sometimes, people will even be looking at operating capital that they have in their business. And, that operating capital is there as a buffer to give you a year of cash to draw on should something happen to your receivables where you can't actually collect them as quickly as you expected, or something happen to your revenue where it turns down. And a lot of people have fixed costs in their businesses, in their house, and whatever savings they do have or cash they do have, they funnel it into risk assets. And that's often, sometimes even recommended by some accountants who think that, your cash is just sitting there, is not doing anything. You should be doing something. You should be whipping it like a dog team. I mean, the reality is it's there as a buffer, as a safety valve, as a way to keep you afloat, solvent, if there's challenges to your income side. So I do think that we need to really carefully and soberly assess how much liquidity we have that will, if there's a problem on the income side of our balance sheet, or of our income statement, what we can draw on as a stabilizer when we head into a downturn. We're certainly due for a recession here, not just in Canada, but in North America and many countries in the world. And that means typically less income flow. That means probably rising unemployment again. We've already been at really, really low levels of unemployment. And so you have to always think of not just, everyone's fixated on, oh my goodness, I'm missing out. That's exactly the panicked wrong response. You need to build the foundation from the base up so that you are stable and strong and resilient when everyone else is teetery and shaky and selling in a panic. That's when you want to be picking up assets at great valuations. So, I think that's about the best general advice that I can give.
And we also have a few more questions from David. I'll just wrap them all up in one here. Given the behavior of the government over the past week in freezing bank accounts and stealing funds for political reasons, I'm considering moving a lot of my savings out of Canadian banks. Is that a prudent idea? And where can I put it that's safe from the Canadian government and foreign theft?
Well, I would suggest to you that moving it out of the Canadian banks to somewhere safer is a very tall order indeed. I know people all over the world who are, concerned about the stability of their banks, whether it be in Mexico, whether it be in Europe. I think that, generally speaking, our banking structure is more secure. Our rule of law is quite strong. Our contractual protections are better than most countries. So as far as, yes, of course, if banks fail, there can be a loss of deposits. And that is a great risk for everyone. I always say there's no truly safe place to store money, not under your bed, not in a hole in your floor, not in your bank. But having said that, these are always about relative choices, right? And the relative choices are that if you have some capital in Canadian banks, as long as it's not in these highly risky products, God forbid, cryptocurrency ETFs or all the nonsense they've come up with this cycle, or, highly concentrated shares and equity components and all that stuff. As long as if you're talking about GICs, cash in the bank, as I say, operating capital, savings accounts, that stuff is about as protected as you can get worldwide. And if there is a problem there's, things like CDIC coverage as well, but there's also, the Canadian government very likely to backstop the banks to the extent that depositors are at risk, not to the extent that bondholders and stock investors are going to lose money. I think that they need to lose money because they've been indiscriminate in the risk they've taken. So that would be a capitalist approach to allow that process to happen. But as far as, my point at the outset, I think, was that I don't think the Canadian government has done enough to follow not legitimate flows, not the legal deposits of their citizens, but I'm talking about the illicit flows of the oligarchs and the fentanyl trade and all that's been recycled through our banking system and into various businesses and property enterprises. So that's the stuff that I'm really hoping that the Canadian government becomes more focused and serious about. In many ways, all levels of government have just turned a blind eye because asset prices were going up and because people think it's great when their housing goes up. But at the end of the day, it's not a free lunch. It's extraordinarily expensive. And we're seeing that right now in terms of the inability of people to buy affordable housing, the inability of young people to launch, the fact that, people in their 30s today, only 4% of them own a house compared to 30% or more of the baby boomers at the same age. So there's a long-term cost here in terms of household formation and the taxpayers of the future to help drive all of the revenue and pay the entitlements and all that sort of thing. So anyway, those are longer-term big picture items. I don't think that the Canadian government is the most likely to be seizing the deposits of legitimate people.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.